I actually got it the first time. It wasn't that bad.
Okay, great. So you didn't look at the solution. You obviously did it like a test question and then obviously checked it, right?
Yes.
Okay, perfect. That's the ideal technique or preparation. Great. Yeah. So then I don't think we need to go through another liquidation unless you want me to go through what it's.
No, I'm good. I think I'm good with liquidation, and
Okay.
we'll go through it when we do revision.
Yeah,
So,
perfect. Yeah, there should be questions on it in the actual past papers, so we'll see them when we get there. This is Unit 6, which is the close corporations. Okay, so we went through the notes last week. Let's have a look at the practical questions. Okay, so the textbook, let's see what the textbook has given you in terms of additional information. Learning Unit 6, close corporations. Okay, a little bit of background information. Okay, we spoke about the different key concepts. This was obviously part of the theory that we looked at. Just to recap some of it, what is members' contribution?
it's basically capital, but like for members.
Good. And profit distribution?
It's like appropriation, like how we had appropriation for partners, but this would be for members.
Okay, appropriation is a working account.
Okay.
Profit and loss is a
Is it
working
like the
account.
ratio? Is it like the ratios?
No,
Uh,
profit distribution would be like drawings.
oh, okay.
Okay, so if you distribute a profit, it would be called a distribution. Okay, where would you
Okay.
show drawings? You would show it in the SOCI. Retained earnings will also be part of the SOCI, right?
Yes.
Okay, good. Right, tax. What do you know about tax? Something new. SARS is?
Tax.
Yeah, SARS is the liability because you have to owe a certain amount that has to be paid to them, right?
Yes.
Tax is
Which one would
what?
be an expense? An
Tax is?
expense? An expense.
Yes. Okay, good. Right, obviously, profit for the tax, profit before tax would obviously be before taking tax off. So before tax and then minus tax. Make sense?
Yes.
Okay, good. Right, that's just background. Okay, there's even a note here about the Companies Act. Let's see. Okay, this is theory. Advantages, disadvantages. This is also theory. It's not often that UNISA tests theory in a subject like this because obviously it's accounting. So the focus is on
Um,
practical questions. This might come up maybe in multiple choice, but it's not often tested. But it's good in terms of understanding. So definitely go through the textbook if you can. It does help.
Anthony, I was meant to actually tell you that I got a date for my exam.
Okay, good. And
It's the 24th of November.
let me just see on the calendar. Yeah, that's right. We said we had classes till the 17th,
Okay.
according to the
And it's
calendar.
online.
What is that?
It's online, my
Okay.
exam, and the time slot that they gave me is from 11 to 3.
Wow. Okay,
So I don't
that's good.
So I don't know what they're going to ask or how they're really going to format it if it's online.
It's probably going to be multiple choice then. Yeah, similar to the assignments.
Okay.
Yeah. So if it's not written on campus, then obviously it might even be a submission. Hey, it might be like do it online and then submit your answers type of thing, or just choose the right option. I
Yeah.
think.
I think because FAC 1502 was like they timed you and we had like 20 questions, multiple choice.
Okay, so if it's over a let's see, 11 to 3, what's that? 4 hours? Yeah, no, 12, 1,
Yeah.
2, 3. Yeah, 4 hours. That's right, eh?
Okay.
11 to 3.
Yes. But
So
then
it's
I
probably a submission. They should give you more insight about it. I mean, they have to communicate that to the students.
I think they will maybe closer to the time, but I just got emailed my timetable. So,
Okay. Yeah, I knew about the date. I have the dates. I know that's why when we planned your weekly lessons, obviously we went through till 17th. Yeah, so 17th is the week just before the 24th.
oh, okay.
Yeah, so there's still obviously this week you've still got 1, 2, 3, 4, 5, 6, 7. Yeah, so there's still 7 weeks of content that we can go through, and we're doing quite well. We're already on study unit 6, and I think there's how many? 7, 9, 7, 8, 9. I think 9. Yeah, 9 chapters to cover. Yeah, so today we're going to finish 6. 6 will be complete. With 7 we can go through the notes today, and then next week we'll complete 7. It's also very easy and short because it's just looking at companies. There's not a lot there. It's mainly equity and how equity is issued in the market. 8 is very short. 9 is the long one. That's the big. That's a very important one. Okay, that'll take maybe
Okay.
2.5 weeks.
Okay.
Okay, yeah. So by let's see, 1, 2, 3. Definitely by the end of October, we would have finished all the content, and then it's literally just past paper, past paper, past paper until the end.
Okay.
Okay, yeah.
No,
So
so
if you
we
want
are
to
good.
start looking at past papers, you can, but obviously don't cover sections that you haven't looked at because past papers will split the questions up. So if you do want to
Yes.
start practicing, you can look at any past paper after today that covers any of those first 6 chapters.
Okay.
So if you see a partnership question, maybe you can start like trying it. Maybe put your answers together, do it on separate pieces of paper, and then just keep it all together. And then when I do it with you later on, because I'm going to show you one paper from start to finish. So I always do the first paper, and then later on, you'll try do more of it, and then you'll just check your answers with what I've done and what we'll go through.
Okay.
Yeah, so if you want to start preparing, because you are very diligent with your studies, so if you do want to start practicing, definitely cover the content. So make sure you know what's happening in each of these study units. And you can always go back and you can go through some of the content again if you need to. But once you've got that right, and once you've got the theory and the knowledge, okay, then you need to start applying it. Because with a subject like this, you're not going to really study for it, you're going to practice for it. So you have to do paper, 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 and you have to keep doing papers up until that last day when you're actually writing the test. Because that's how you prepare for a subject like this.
Okay.
Okay, great. So let's go back to that page. What was it? I forget now. I think it might have been 170. No,
I
170.
think it was like 113.
Too much. 113. Perfect. Thanks. Great. Okay, so we went through a lot of this already. Let's just go through the rest. Okay, members, owners of the business, right?
Yes.
Okay, they have a contribution. They also have loans to, loans from. This is just background regarding the actual operational side of things when looking at CCs. Okay, we know that CCs are separate legal entities. Do you agree?
Yes.
Okay, so in terms of members, members are seen to be separate from the business. Obviously, they are responsible for the business, so joint liability of members and others for the debts of the close corporation. Okay, so remember when we said when looking at companies are obviously separate legal entities and they obviously need to meet their own obligations, right? Because members are owners of the business, they're like the shareholders, right? They have joint liability, but it is limited because you have a separate legal entity. Okay, but they're still obligated to meet the obligations of the close corporation. Okay, tax we looked at last week. Okay, here's the financial reporting. That's the disclosure. Okay, there's an example here, activity 4.6. Okay, this is just looking at disclosure. This we'll see in a longer question. Okay, they're talking about a deregistration. That's when a closed corporation basically ends, which is possible. And there we go. Okay, so you had to do some adjustments. Those adjustment workings you can discuss later on when we actually look at it, and then we can complete the disclosure. Okay, so first thing we need to look at, layout and format. Okay, so let's leave that up. Okay, disclosure questions, CCs. Right, remember I've given you some general templates that you can actually use. They're a PDF documents that you can maybe print out, and you can actually do the questions written just to practice. I'm just going to draw it up. Obviously,
I think
you
I'm
have.
also going to stick to
Okay.
Excel if our exam's online.
Yeah, if it's online, do it on Excel if you want to. It's up to you.
Yeah, I think it's the quickest method.
Yes, because it can add everything up for you, and you can delete and you can redo and all of that. So I would do it as well online if it's available, and you have that option. Statement of comprehensive income. Okay, well, let's write the whole name. Profit and loss and other. Right, so that's the first statement. Sales, cost of sales, gross profits, other income. Remember, with the other income and other expenses, you can have different disclosures, so you can group things. For example, UNISA groups things with the admin expenses and that type of thing. So you can do the same, or finance costs. You can also do that. So I think with finance costs, we'll leave it separate, but the rest we'll just group it. Other expenses. Okay, and then we can say operating profit before finance costs, less finance costs, profit before tax, tax, profit for the year. Okay, there's the one statement. Well, I like using two columns. I'll use two columns here. One for totals, one for workings. Let's put total columns for those line items. Okay, there's the one. Right, then we need to do another. Financial position. And then you'll have assets equaling your equity and liabilities. Okay, we just need equity. Let's just move it down. Actually, that's fine. We'll just delete this. Right, and that's it. Oh, Forgot the SOCI. We need that. Okay, statement of change in equity. Okay, with
The
the SOCI,
question,
you're going to have lots and lots and lots and lots and lots and lots and lots of columns. Right, so let's just put a whole bunch of columns here. Should be enough. Okay, and then we'll just
just a
put,
question.
yeah,
Under required for B, it says prepare the statement of changes in net investment of members.
yeah, that's the statement of change in equity. They just changed the name, so net investment of members. Yeah, it's all
So
the
it's the
same
same
thing.
thing.
The vocabulary can change just depending on what type of business you're looking at. So obviously, net investment means the investment that the members have in the company, which is the SOCI.
Okay.
Okay, and then the totals, and then the total at the end. Okay, yeah, I think that's fine. Maybe actually, if I move this across, I don't think it'll do much. Yeah, it's fine. It'll be better like that. Okay. Okay, there we go. Perfect. We're ready to start the question. Right, so obviously, maybe what I will do is I'll copy this just so we have a template. So when we do another question, at least we have that to work with. Okay. All right, so everything looks good. Yes, we've got everything.
Yes.
6.1. Okay, you've got left and right. They're looking at a CC 50-50 each. Okay, so members' contribution, L and R. $50-50, that's important to note as well because of possible distributions. Okay, this is the end of the financial year. They've given you a trial balance together with additional information. You're obviously the accounting officer. All right, so dates are important. This is the 30th of June, 2015. Look at the required. What do they want here? Okay, the required says prepare the statements. Everything is for 30 June. Yeah, so that's fine. That's end of the year. Okay, perfect. So this would be before adjustments, but at the end of the year. Okay, so members' contribution, left and right. Okay, BOY, beginning of the year. EOW, not W, EOY, end of the year. Okay, right, you can write in, or you should write in those dates. I'm just making it generic and just easier to write in, quicker to write in. All right, next. Left and right, what did you say those accounts were? Give me the accounts. What are they?
Capital. So 10,000 for both of them under SOCI.
Yes, okay. Actually, we should put it here. Unless told otherwise, you would assume it's the end. Okay, loan to and loan from?
I know loan to members would be an asset.
Loans to, yes. Okay, it's a debit balance, it must be an asset. Right, disclosure wise, you've got to show it here as well. Okay. Loan to L, loan to R. Okay, loan to. This is 18, but that's the end of the year. Okay, do you see that?
Yes.
The dates there, hey? July 2014 is beginning. What is it? 6, yeah. Okay, next. Machinery, what is machinery?
Anthony, what happened? Your members' contribution kind of went away.
No, it didn't.
Oh, it's at the bottom. Okay.
It's the end of the year, yeah. Because remember, this
Okay.
was for 30 June 2015.
Yes.
So unless I have a bracket here, 1 July 2014, it must be end of the year.
Okay. Would we
Okay.
also disclose this under statement of financial position?
Yes, later, because the SOCI will be disclosed there at the end.
Okay.
Because remember, whatever you get here in the statement of profit and loss is going to go here as profit for the year after all the owner's stuff, and then you're going to do the
Put
financial
it under
position. The
equity.
financial position is always the last thing that you have to do because that thing will balance.
Okay.
Yeah, so I'm not going to worry about it now. I'll just take totals from here and reference it there later.
Okay.
Okay, what's
Machinery
next?
at machinery at cost would be asset statement of financial position.
Yes, okay, so machinery in brackets, the cost was 51.
Yes.
Okay, next.
Accumulated depreciation 7,000. So I'd
Yes.
minus it. Okay. Mortgage is your liability, so 40,000.
Yeah, and you would assume it's long term unless told otherwise.
Okay.
What is this? Beginning? Okay, it doesn't really matter because this is for the
It
financial
was
position.
beginning.
Okay, it is 40. Yeah, it is 40. Okay, next.
Land and buildings 200,000. So assets.
Okay.
Improvement to buildings. Okay, I'm kind of, is it between an expense and an asset?
Okay, if it's an improvement, it's going to have an enduring benefit. So would that be a asset or or an expense?
Oh, good asset.
Yes, because you're improving the building. You're not repairing the building. If you're repairing the building, that'll be an expense. So this would be something that you'd have to look at later on because it's unusual because you shouldn't see it here as a separate line item. If it was an improvement to the building and it was done at the end of the year or during the year, it should have been added to the building. So I would asterisk it here, okay, as part of buildings, as a plus. Add the improvements. Okay, but when you see something like that, that I would highlight because there's definitely going to be something about it in the dish information, guaranteed. Because you don't often
Okay.
see something like that on the trial balance. That's unusual. So that you could highlight. Okay, it is an asset though. It should be capitalized because it's an improvement to the building. It's not repairs or maintenance.
Okay.
Okay, trade receivables.
Asset, current asset,
Yeah,
16,000.
receivables.
Telephone expense would be statement of comprehensive income. That's 1,260.
Stationery consumed.
Station is also an expense, 380. Petrol's also an expense, 4,000. Services rendered would be under sales
No. Services rendered is a
or
service business. It's not a sales. Sales and cost of sales is for a trading entity. Services rendered would be services rendered. It's for a
okay,
service
so do we put
business.
it
So that
under
has to be disclosed separately. So looking at that, this business actually doesn't have any sales, does it? No, it doesn't. Right, so it's not a trading entity, it's a service entity. So we can delete all of that and we can just record it at the top.
okay.
Ooh, if I delete it, it's going to shift all this stuff at the bottom. Okay, I'm going to leave those lines there. I'm just going to block it out. Okay,
So
services
that would be
rendered 382.
380. Yes. Water and electricity expense 5,800. Salary, I remember you saying this is an expense.
Okay, if this was a partnership, None of this will go into the disclosure for the income statement because it's not a separate legal entity. But because this is a CC, salaries with members have to be shown, but shown specifically under other expenses, but identified as salaries to members.
Okay.
That's just the specific disclosure. Yeah, so when you have salaries here for left and right, and because this was paid, you would have to show it. Okay, is that alright?
Yes.
Okay, what else?
Remuneration accounting officer.
Yes, that's
Is that
more.
expense?
Yeah, that's more expenses, correct. Okay, I actually do need to move this down. Okay, let's delete this column. And then it won't mess up all the other lines. Yeah, that's fine. Okay, if you go through the textbook, you'll see they talk about key individuals. And key individuals, like the accounting officer, need to be disclosed separately because they're important. So you would have to disclose them as a separate line item on the face of your statement of comprehensive income. It was 12, yeah. Next.
Deposit petrol. I I think it's an expense.
Okay, it can't be an expense because it's a deposit. What is a deposit?
So it's when you pay like the first 10% or a minimum amount for a product or service.
Yeah, kind of. Just think about it from a banking perspective. If you make a deposit, what is that viewed as?
A payment?
Well, yes, but a deposit is a special payment. It's not a payment because it's still your money. So this deposit is a deposit for petrol. So this is your resource until you've maybe received the deposit back or you've actually used the deposit for the petrol. So this is seen as an asset. Any deposit would be seen as an asset. It's probably current because it's for petrol, and petrol will be used on a short-term basis. Okay, the petrol was, or the deposit for the petrol was
1,500.
Okay, what else?
Retained earnings. This is SOCI.
Yes,
And
retained
at the
earnings
beginning of the year,
at the beginning, yeah.
9,200.
Good, yeah. So this you asked me about last week. What is retained earnings? Do you remember?
Yes, so it's when a company keeps profit within the business and doesn't distribute it to the members.
Yes, good.
A CC.
Yeah,
Yeah.
that's right. Bank.
Current asset 6260.
Last one.
SARS is a liability.
No, it can't be a liability if it has a debit balance.
Expense. Okay.
Okay, the
So
bracket
how
is the
would you know if
giveaway. The bracket says income tax, so that means tax. Okay, so it's part of this bit. Okay, and because it's a debit means it's either an asset, an expense, or drawings.
okay.
Okay, it can't be an asset, right? Definitely not drawings. So the only option must be expense, right?
Is that the only way to tell
Yes,
if
because
it's
the balance. So income tax means part of the operations of the business. Debit balance means assets, drawings, or expense.
okay?
Okay, if it was a liability, then it wouldn't be on this side, it would be on that side.
Okay.
Okay, because liabilities, capital, and income have credits.
Yes.
Okay, right. So look at that. That's more an exam technique tip that I would explain when we actually look at past papers, because you can look at that and you can then decide, right? So because sometimes you see strange stuff like a reserve, and then you're thinking, oh, what is a reserve? Just look at the balance and then eliminate what it obviously can't be, right? So if you see a reserve here, a reserve could be given on the credit side. A reserve can't be a liability. A reserve can't be income. A reserve must be capital.
Okay.
Okay, so yeah, just like use those basic principles to help you in case you get stuck. Okay, because everybody knows those rules, right? Okay, no one should
Yes.
struggle with those rules, right?
Yes.
Okay, because they're set in stone. IFRS outlines the rules for assets, liabilities, income, expenses, capital, and drawings. All right, that's it. Okay, yeah, this is the addition information. Okay, so now you're going to adjust. Tell me what you're going to do. Normal disclosure. This one you should be able to do based on your sole proprietorship knowledge. Not FIN, FAC 1502. What did you do with this
So,
one?
like the workings, I debited depreciation and I credited accumulated depreciation.
Yes. Okay, depreciation is an expense, so it must be disclosed here. Okay, how did you work it out? What was your
I didn't.
depreciation amount?
Does that fall under workings? Because I just did the debits and credits.
Yeah, debits and credits is the working, and then you use the working to get the answer. Okay, so I'm happy with your
Okay.
working. Your working was debit depreciation credit accumulated. That's right.
Yes.
Okay,
All right. So,
what is depreciation? It's an expense. Where do expenses go? Here. Okay, so you're taking the working and you're just disclosing it. That's what I'm doing.
okay.
Okay, so you're giving me the right working. I'm just disclosing what you've got and I'm just discussing it. So depreciation is an expense. Expenses get disclosed here.
Okay.
Okay, what is your working for the depreciation? So what amount did you have in your working? What did you debit? What did you credit? Well, in this case, what did you debit?
The amount. I didn't do the amount. I just did the workings.
Oh, okay, okay. So
Yeah.
you,
Sorry. I
you
didn't know because I didn't know you wanted me to
okay, it's fine.
actually
Do the
do it.
working
I
now
just did
then.
it. Okay.
What would you need to work
Provisions.
out the depreciation?
So the amount
Okay, if you look
times.
at this information, what does the information tell you? It says that depreciation is 10% straight line method, but they also tell you machinery with a cost price of 60 was purchased on the 30th of September. Do we need that?
Yes.
Good. Okay, so what are you thinking about when you see that?
So what I would do is I would take machinery and minus the 16,000.
Okay, that's fine, but that's a little bit too complicated because you should rather just draw a timeline.
Okay.
Okay, so whenever you see a question like this, it doesn't matter what it's covering. If I see another date in the actual addition information, the first thing you need to do in terms of exam technique is draw a timeline. Okay, so
Okay.
what's the start of the year?
Um, 1st July 2014.
Good. Okay, what was the end?
30th June 2015.
Good. Okay, so this is going to be used in multiple scenarios. Okay, not only this one, but this is the first one where I actually need to draw something. Okay, so I need that. All right, do I have that date? No, I have a date somewhere in between. 30th of September is somewhere there. Agree?
Yes.
Okay, what happened on that date? You bought more. How much did you buy?
Mhm.
16. Okay, what do we have in the question? We had this was machinery, right? Yeah. Okay, so machinery
Yes.
51,000, which was that amount. Do you agree?
Yes.
Okay, so we can go back and we can even double check it. See, 51, end of the year. So, what would you have started with? The difference. Okay, depreciation is the use of the asset over time. There's depreciation, and there's depreciation. Right, then I need to just times this by 10%.
10.
Do you agree?
Yes.
Okay, no pro rata for that one. This one, what do I need to do?
Times it by 10 times 9 over 12.
Let's check
9.
your months. Okay, so do you count September?
No,
Why not?
because it's the end of the month,
Good. End of September is actually beginning of?
October.
Good. Okay, so October, November, December, January, February, March, April, May, June. 9 months, I agree. Okay, so answer there. Okay, so now I've got it. 1, 2, 3, 5. Okay, there's the depreciation for the machinery. Don't forget to put it here as well. Alright, that's it. Was that it? Let's just double check. That's that. Good. Got everything fine. Next. Number 2.
You didn't give me 2. You said 1, 3, 4, 5, and 6.
Okay, it's fine. If I didn't give you 2, that's fine. We'll look at it. The members decided to capitalize the improvements to the buildings. Okay, so here's that note about the improvements. Remember, we said capitalize
Yes.
means to add to the balance, right?
Yes.
Okay, the land and buildings consisted of a plot purchased, obviously, previous financial year, August 2013, so before, and it was for 200,000. Okay, no depreciation is provided for on land and buildings. That would be in line with IFRS. Okay, because this was prior to the financial year, it happened before. So the improvements were capitalized but not recorded as part of. So we need to add it to the land and buildings. Okay, so the improvements to land and buildings needs to be adjusted for. Okay, so we had that improvements earlier. Let's go back. Where is it? Here's it here. Improvements to buildings, 31 January 20.15. Okay, the dates aren't really aligned here, looks like it. Because here you've got improvements, but improvements at the end of the current year. Here they're saying the members decide to capitalize the improvements to the buildings. Oh, okay, that's fine. It makes sense. Yeah, so if they're saying they're going to capitalize the improvements, they've made that decision now. Before they just kept it separately. Right, but because they've agreed on capitalizing it, you are going to have to add it. So add the improvements, 55,000. Okay, is that all right?
Yes.
Okay, the purchase took place long ago, so it's obviously going to be part of the balance anyway. What is the land and buildings balance? 200,000, yeah, so we've got the 200. That's the history, that's the past. Okay, next.
So for 3, I debited interest on mortgage and credited accrued expense.
Yeah, that's fine, that's good. Amount?
We can work it into this.
You can work it out now if you haven't done it, that's fine, not a problem. How do you work out interest, do you know?
Yeah, so it would be 20% times, what was the mortgage amount? 40,000?
Okay, we need to look for that figure, right? Again, because you've got dates here, I would do this. Copy
The
paste.
timeline.
Let's don't write loan, let's write mortgage. But it could be a loan, it's a type of loan. Alright, so what is the mortgage? Go back, check. Where is it? Here's it. 1 July 2014, that's the start, not the end, right? 40, hey?
Yes.
Okay, delete, delete. No, don't delete that one. Okay. Alright, was that it? Yes. Go and read the question again. Interest on the mortgage, 20%. What else? Let's see. Interest is payable on 1 July 2015. 1 July 2015 is next year. So there will be an accrual. So accrued interest is good. Accrued interest expense is good. Okay, the loan is obtained on the 1st of July 2014, so start of the year. Secured by first mortgage over land and buildings, the loan is repayable on 1 July 2022. That's obviously in the future, that makes it a long-term liability. So no pro rata. Okay, well, when I say pro rata, I mean no splitting. You don't have to split the loan into long-term and short-term. Okay, because the loan is only repayable in 2022, which is much, 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 much further on in time. Does it make sense?
Yes.
Okay, so mortgage 40,000. Did you have it for the whole year? Yes. Oh, 20%. 8,000 is the interest. Did you get that? Or do you agree with it?
Yes.
Okay, good. All right, where do you show that? Well, you said debit interest, which is a finance cost, so you would show 8,000 there, okay, which is the interest, and here, accrued interest expense, 8,000. Happy with that?
Yes.
Okay, 4.
Oh. Okay, so they still need to be accounted for. So for Telkom, the first one, I debited telephone and credited accrued expense.
Okay, so here they said must still be accounted for. Good. So we can write down accrued expense here, or accrued, what is it, telephone expense.
Yes.
Okay, how much? 150. All right,
Yes.
you also had pence and pencil stationery
Ex-
for stationery. Okay, this is something else. What is it actually? Oh, actually it is the same.
it's the
Because
same.
this was all payable, yeah. So if it's all payable, it means it's still an accrued expense, yeah. So it's actually a copy paste. Okay. All right, and what did you do with the
It's under
telephone here? Do you
expenses.
add or subtract? What would you do?
Add.
Good. Debit means plus for an expense. Okay, expenses increase on the debit side. All right, number
Yes.
5. This one, looking at it, you can do this one.
So I debited credit loss.
Good.
The amount I do not know.
2.5.
Yes.
Okay, what did you credit?
Trade receivables.
Good. Minus 2.5. Next, number 6.
6, I debited interest on loan.
Okay, so this is just a normal loan calculation that you have to do. Imagine you had any other loan, okay, but it's unique or it's special because you've got a member involved here. So again, I would be looking at dates here because they talked about a date there, and they looked at this January. Okay, so January is obviously during the year. So again, copy paste, loans. Is this loans to or loans from? The members decided that as from 1 July, interest at a rate of 80% will be taken into account on their loan accounts. Okay, a new loan of that was granted
2.
to. Okay, so loans to. Okay, good. Right, you were saying, what did you do with this?
I debited interest on loans and credited loans. I
Okay, let's
do.
think about this. If it's a loan to asset or
Yeah,
liability.
it's an asset.
Okay. Right, so you're not going to credit an asset, you would debit the asset if you're going to add more interest to the loan. All right, so let's read it. The members decided on that date, interest is 18% per annum. Okay, will be taken into account on the loan account. A new loan of 10 was granted to left. Okay, so granted to left on the 31st of Jan. Okay, new loan for left. Okay, how much was it? 10. Alright, what else? Interest on these loans is capitalized. That's important because it's added to the balance. Both loans are unsecured and immediately callable. So both loans are short term. Alright, so we need to go back. Okay, where are the loans to? Here, loans to members left. Okay, we need left. 18,000 was at the end. Okay, loans to member right was at the beginning, 6. Okay, so did I have this loan for the full period? Yes. Did I have this loan for the full period? No. Did I have the 8,000 Rand loan? For the full period? Yes. Okay, so obviously, if the balance is 18, okay, 10 was received during, okay, so the other amount is going to be the balance. So interest is going to be calculated using pro rata for this one times 18% times, count the months. January don't count, so Feb, March, April, May, June. Do you agree it's 5 months?
Yes.
Okay. $750 for that one. This one, $1,440, and this one, okay, there we go. That's it. Right. So all of those amounts need to go as interest amounts for those members' loans. So, okay, remember, it's a loan to. If it's a loan to, asset liability.
Asset.
Good. So assets generate income. So you will have
Yeah.
other income here. Okay, remember, if it's other income, you're looking at income that is being generated through other operations. So obviously, interest on the loans to members. Brackets. What are the amounts? $750, $144. Okay, you remember the last one. $750, $144. What is the last one?
1080.
Okay, perfect, great. All right, that's what we've got there. This loan interest needs to be capitalized. That's what they said in the question. Let's just double check. Where was it? Here. Interest on these loans is capitalized. So because it's capitalized, you're not going to show an accrued expense. Right? You would if this wasn't mentioned in the question. Okay, so your working had accrued expense. I would change that. Not accrued expense, accrued income. Okay, accrued income means interest that I'm still going to get. I'm still going to earn because remember this was income. Right, so it's accrued
Yes.
income. Income that's still going to be received. Does it make sense?
Yes.
Okay, let's put that in. Okay, we need to show it. Loans to O. Actually, because this is special, where's my associate here? Interest on loans to members. Okay, loan to L equals, what was the loan to L? It was 750 plus 144, enter. Okay, the loan to R was 1080, there we go.
Could you also put this under your statement of financial position?
Well, if I was only asked to do the statement of financial position, then I would show it on the face. But because I've got this, I'm going to show it here and just reference the total.
Okay.
Okay, so loan to L, we actually need to update this. The loan to L balance was 8. Okay, we read that in the question. It's in my diagram. I wrote it down here. See, there's
Yeah.
the 8, there's the 10. We spoke about it. Remember that?
Mm-hmm.
Okay, and then you've got the 6 as well. So 8 and 10. There's the 8. We need to show the 10. That gives us the 18. Because it's being capitalized, you need to update the total. Because they tell you that interest must be capitalized. So you're gonna have to add the interest to the loan. Does that make sense?
Yes.
Okay. Alright, the 6 we had, that we have, okay, that we can just add up. That's pretty straightforward. Add up. Alright, that we'll reference the stuff later. Let's finish it first. Okay. Was anything else here? No. Did I record the interest? Yes. Did I record the other half? Yes. Okay, next. What's happening now?
The actual current income tax for the year amounted to 83,044 and must still be recorded.
Good. Okay, so yeah, this one you probably didn't know because it's new. So the tax, they're referring to this. Right, they're telling you that the tax should be 83044. And remember, this is a negative. So negatives in accounting, you show in brackets. Do you agree?
Yes.
Okay, are you showing 83044? No, you're not. You're showing 21. So is it an accrual? Yes, there's an accrual. How much is unpaid? The difference. Does that make sense?
Yes.
Okay, what is the difference? Difference is 62. So, show plus 62044. Okay, because you're debiting, I want to write this down actually. Let's do it here. Or no, let's do it here. Debit, income tax, expense increase, credit tax liability, liability increase. Okay, and it's the difference. Okay, we've got the answer. Just write it in. There we go. Okay, there's the working for that figure. All right, have I disclosed the expense? Yes. Have I disclosed the liability? No. Okay, so tax liability. $62044. Got that? Does it make sense?
Can you just explain the working to me again, please?
Okay, so how much tax were we supposed to pay?
83,
83,044. How much tax have we paid? 21,000.
21.
What do we still
I
need to
understand the
pay?
difference, but why did you put it under tax liability and not accrued expense?
Because it's a special liability. It's not an accrued expense. You could say accrued tax liability, but then you're using the vocabulary loosely. It's not entirely correct. It's a tax liability, or you could even say it's a SARS tax liability. That's all. If you really want to, you could call it accrued income tax expense. But then, yeah, it's just you're just being a bit more specific or less specific with the vocab. That's all. All right, but I wouldn't record this as an accrued expense. I would rather record it as a tax liability because it's a special line item. Tax is special.
Okay.
Yeah, that's just vocab. I don't think they'll mind as long as you've got either or there.
Okay.
Okay. Is that it? Are you happy with that?
Yes.
Okay. Last one, or
The
second last one. There's
members,
still two actually. 8.
yeah. These ones I think are new because I don't have it for homework, but we can do them now.
Yeah, let's
The
discuss them because yeah, they are new. The members decide to distribute 60,000. Okay, so when you distribute 60,000, it's part of the changes in equity. Obviously, there'll be profit for the year. Okay, and then there'll be a distribution to members. Okay, the distribution to members they're telling you here is 60,000. And this is, let's read the rest. Okay, so 60 is going to be distributed for the year end. Okay, equally between them. All right, so 30/30. These amounts will not be paid out in cash. Okay, so if it's not paid out in cash, you're not going to credit bank, but will be left in the closed corporation as loans to the corporation. Okay, so if it's a loan to the corporation, it's going to be a loan from the member. Does that make sense?
yes.
Okay, so remember it's just context. Right, you're looking at loans to and loans from. Does that make sense?
Yes.
Okay, so loans from, what is the first guy? L. Hey, yeah. Loans from L and loans from R. Okay, the loan from, the distribution is going to come out of profit. So retained earnings is going to come down. Retained earnings will have a minus 60,000 because you have to get the money from somewhere. Okay, that's minus 60. And it's going to go 30 here and 30 there. Okay, that's what they said. Read it again. Let's double check. It's not paid out. It's going to be left in the corporation as a loans to the corporation. If it's a loan to the corporation, it's a loan from the member. These loans are unsecured and an interest rate of 20% per annum is applicable. Okay, the interest will obviously only apply next year. It was further decided that 50% of these loans must be repaid on 31st March 2016 and the balances on the 31st of December. Okay, that's disclosure. Long term, short term. Okay, I want to write above these words. Loans to, we said, was an asset. Do you agree?
Yes.
Loans from would be a liability. Okay,
Ability.
that's in the notes. Don't forget the differences between loans to and loans from. Remember, you're looking at it from the business's point of
Come.
view. Okay, so a liability will be disclosed here. Okay, so there will be a long-term portion. Okay, it's obviously 30/30. So loans from members, in brackets, 30 plus 30. Okay, minus. All right, how much is short-term? These loans are unsecured, interest is 20%. It was further decided that 50% of these loans must be repaid. Okay, 50% are half the loans. Half the loans must be repaid on March 16, which is next year. So minus half the loans. So minus 15, minus 15. Half the loans are short term. Okay, there's the disclosure part of the question. Was there anything else here? Let's see. We've got the loans. The interest will only apply next year. We've disclosed the short term and the long term. I've disclosed that. I've disclosed that. I also need to update this. No, I don't have to update this because this is loans from and loans to. Yeah, that's fine. That will stay as is. Okay, does it make sense?
The only confusing part is the double. When do
What
you,
double?
because you have it under the SOC and the statement of financial position.
Yeah, that's special disclosure. That's just part of IFRS.
Okay.
Yeah, so when you have loans to, loans from, you have to have additional disclosure.
Do you only do additional disclosure for loans?
Yes, loans to and loans from.
Okay.
Yeah, it's a requirement that IFRS has for the closed corporations because remember, a closed corporation used to be abused by those members because it's like the best of both worlds. You have a separate legal entity, but then you have members that can basically do whatever they want to in the actual organization. It's not as restrictive. But this was before the Closed Corporation Act was absorbed into the Companies Act.
Okay.
Yeah, so it's just more detailed disclosure because people could have started CCs and then just take loans from these things, and then these things basically go belly up and insolvent, and then they don't. Then they just stand back and say, "Well, I'm protected because I have limited liability, so don't touch my assets." Okay, that's bad, and that's why government said no. We're going to stop this. Okay, these businesses need to be in line with the Companies Act, and those owners or members need to be responsible for the company or for the entity, right? And that's why CCs today are viewed as companies. Are we
Okay.
right?
Yes.
Okay. Last one. Members' contributions were paid in full and no additional contributions were made during the year. Okay, so it was paid in full, that's during the year, and no additional. Okay, so that means that there were no additional contributions. So what they started with is what they ended with. Does that make sense? Okay, because they said no
Yes.
additional contributions were made during the year. The members' contributions were paid in full. Did this business start, or was this business existing? It doesn't say. Okay, if they started, then I might put zeros here, and then show the contribution that was paid in full. They tell me it was paid in full, but I mean that would have happened last year or the year before, or whenever they started the business. If there's no additional contributions, then you're not going to show anything. It'll be zero. Okay, and that's it. At the end, yeah. Okay, now we go to this and we tally up. All right, so let's do the tallying up. Okay, income, expenses. All right, there we go. Add up. Okay, remember, expenses are negative. So I'm just going to put it in red just to show it as a negative. Obviously, you would show it in a bracket. Okay, so add and subtract. This amount is going to be this plus that minus this is that figure. Okay, less finance cost of 8,000. Okay, gives me that figure. Less tax of that. I'm going to make this a negative. Gives me that figure. There's the profit for the year. Okay, that profit for the year is going to be disclosed where? Here at the bottom. Okay, retained earnings. All right, where's my profit for the year? There's it. Okay, so profit for the year equals that figure. All right, now I need to balance this. That's balanced, that's balanced, that's balanced, that's balanced. This one isn't. Okay, so add and subtract. Gives me that figure. Obviously, loans here, you had nothing to start with. You had 30 to end with. Okay, and that was it. Eh? This column is extra. All right, now we need to reference all of this in your financial position. Okay, so members' contribution is equity. Members' contribution. Brackets. Okay, I don't even have to show the brackets. I'll just add it using the formula. Okay, so members' contribution L plus members' contribution R. Enter. Okay, that's there. Right, what else is equity? This is an asset. Do I have that asset? Let me go check. No, I don't. Okay, so loans to members. Okay, this is loans to members, loans to L plus loans to R. Enter. Okay, asterisk from the SOCI. Okay, obviously, if you weren't asked to do the SOCI, I wouldn't do any of this. Okay, in the exam, don't waste time doing stuff you don't need to. Right, if you're going to draw this up nice and laid out and perfect, you're not going to get any marks for it. Right, so don't do it if you don't need to. If you don't need this, then do everything on the face. Then I would have shown all of these straight on the face of the statements. Okay, retained earnings, equity. Are you still okay?
Yes.
All right, retained earnings, what was it? It was that figure. What else? Loans from. Okay, I think I've got that already. Yeah, there's the loans from. There's the loans from. That was it. Great. Okay, we finished that. Let's finish this. Machinery, tally up. Land and buildings, tally up. Debtors, the deposit, the bank. Okay, current assets, sum up. Non-current assets, sum up. Total assets, add up. Okay, there's my total assets. All right, your total assets should, if all goes well, equal the total equity and liabilities. Okay, so equity equals sum up. Okay, mortgage, loans, add up the current liabilities, add up the non-currents, work out the total, add up this and that. Total equity liabilities, this plus that is it the same, hey? Yeah. Okay, good.
Yes.
That's correct. 342,830, 342,830, great. Okay, let's see what they've done. All right, so how close are we? Let's check. Okay, so, okay, I'm just going to check the total. If the total's right, then I assume everything else is fine. Where's my total here? Okay, profit for the year, 203316. Okay, brilliant, that's correct. All right, obviously, look at their disclosure. Okay, they've disclosed it using obviously revenue describing the services rendered. Okay, so use the correct, let's say, layout or format that they want. Okay, so this is their format. Use what they've got. So you would literally just take this, whatever I've done here, and obviously I would just replace this with revenue instead of services rendered. Okay, other income, they've got the same things, that's fine. And then obviously admin and other expenses. Okay, that's what they've called it. I've just called it other expenses. You can just rename it admin and other expenses. I've shown all of that stuff there. Was that total the same? Yeah, that total was the same even. Okay, and then what did they do? They also showed it separately here at the bottom. Okay, they showed finance costs first, and then I think I did the same thing. Yeah, there's the finance costs. Okay, but I had a total before it. Right, so my disclosure is a little bit better because I had a subtotal, then an amount, then another total, then the tax, and then another total. It doesn't really matter. Okay, so it just depends on format. You can either add more totals. You could even put a total further up here, but they don't. Okay, that's just additional disclosure. Right, as long as you've got the basics right, everything is fine. Okay, the amount is correct, so that's fine. Okay, what else did they show here? Okay, yeah, theirs is a lot shorter than mine because I've put everything separately. I like showing things separately. So here, members' contribution, they just added them all up as one. Okay, I've shown L and then R because they are separate. I've left it as separate. Okay, loan 2 and loan Where's the loans to? Here's the loans to. 14 at the beginning. 8 and 6 is 40. Okay, yeah, they've just added everything. Right, I've just kept it separate. It's better to keep it separate, actually, but it's up to you. If you want to just tally it up, you can, but rather show it separately because then you can keep track of each of them. Okay, loans to members. This was the loans to, which was that, adding up all of this. The interest, which was capitalized, and then the new loan. Okay, if you add up all those amounts, you should get the 13,270. Yeah, there's the total there, 13,270, same total as them. Okay, but again, this is better disclosure because you're identifying the interest that's being capitalized separate from the new loan instead of all as one. Okay, what else do they have? The retained earnings, we had that. We had the same amount, we did the distribution. Good. The loans from members, we did that. L got a share, R got a share. That's fine. Just shown separately. Right, everything looks fine. Obviously, there's a total column here. It's not often that you need to ask for a total. So I don't often do it because it's normally not asked for. But if you want it, let me just show you how you would do it. If you wanted a total, you would literally just tally up, but lengthwise or row-wise, row by row by row. Okay, so add up all of that, 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 add up all of that. Okay, if you wanted to do totals. All right, but yeah, totals aren't often asked for in most questions. It's just a adding thing that you would have to do. Okay, why is my total not balancing? Did I add up wrong? Maybe I've missed the minus somewhere. No, it looks right to me. Okay. A loan to is an asset. Yeah, that's fine. You're just adding everything across. Loans to would be an asset, so it wouldn't be a negative balance. Members' contribution, what balance would that be? That'll be a credit balance. So you've got a credit here, you've got a credit. Oh, okay, you do have a debit here. All right, so you can't actually add up this balance at the beginning of the year, okay, because you need to consider the debits and credits. All right, so members' contribution, credit balance. Retained earnings, credit balance. Loans to debit balance. Do you see that? Okay, so yeah, you can't just add up all across if you're doing the total then, because here you had assets as well as a liability. So just be careful. That is something to consider. Okay, so then it would be this plus this. Ooh, I don't think Excel will do that working. Let me do it separately. This plus this plus this minus this minus this. Okay, there's the 15.2. That's how they're getting the 15.2. Okay, now it should balance. Does it? Still not. Okay, do I have more debits and credits? Let's check. Assets would be a debit balance. Okay, so if it's a debit balance, it would be a minus. Okay, the new loan, it's an asset, so it'll be a minus as well. Okay, the retained earnings will be a credit balance. Let me write this down actually. Debit balance, credit balance. Okay, I've never seen them ask for a total column, so it's not often something that you have to do in a test exam paper, but I'm just showing it now just so you have an idea. Okay, it's just debits and credits. As long as you know what it is, you can get it. Okay, those are assets, those are liabilities, those are equity. Okay, was there anything else? No, there wasn't. All right, is the figure up to date now? What is it? Let's sum up. Okay, enter. Yeah, now it's right. Okay, you can see it there. 205246, that's how they've got that figure. Right, so just be careful with the balances. All right, because you do have debits and credits now only because you have closed corporation disclosure. Closed corporation disclosure requires you to show that the assets for the loans to and the liabilities for the loans from. Okay, and that's obviously going to change it. If this was a normal SOCI, then you would literally just add up across because all of these things were owner's equity, right? If you go back to partnerships, here, let me go show you partnerships quickly. There, Partnerships, we just totaled right across. Totaled right across, total right across, total right across. That's all to get that total column. Okay. Happy?
Yes.
All right, perfect. All right, let's just compare this. Let's see. Assets, what is the total? Let's just check the total. Total assets, 3428. Yeah, that's perfect. Equity liability, same thing. Yeah, so everything here should be fine. Okay. Right, and that's what you should be looking at doing for all of these example activities. So we've done, let me just write it down. Activity 6.1. Okay, that's a disclosure question. These questions are very, 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 very popular in past papers. You will get one. It's not going to look like this though. You'll never ever be asked to do all three. Okay, if you've looked at past papers already, you'll see if they give you a CC question, they're either going to ask you for this, if this was the exam, or they'll ask you for this, or they'll ask you for this. They won't ask you all of it in one question because then this one question could be out of 100 marks.
Okay.
Okay, all right, so when you get to exam papers, you just need to basically focus your attention on what's being asked. If they're asking me about this, then I'm only going to be looking at loans to, loans from, and owner's equity. That's it. I'm going to forget about all the other stuff because I don't need it. If they're asking me about income and expenses, then I'm going to be looking at that. If they're asking you about assets and liabilities, then I'm going to be looking at that. And that's how I would do it in an exam. Okay, but I will show you that when we actually do past papers. Okay, you'll see the exam technique. It's quite simple. But you need to get to a stage where you're ready to do exam papers. And that's why you've got all these study guide activities to practice. Right, so I've done this one for you. I've done it with you in detail. We've spent a lot of time going through the workings and calculations, which is good because I can see that your basics are very good. Your basis is strong in terms of your adjustments and other. Okay, I just want to go back to the question here. I want to see how many more you have in this study guide. Okay, yeah, you can see they've got lots of workings here, which is good. Okay, workings, see, for example, here, that's their working for depreciation because of the notes. Okay, my working for depreciation was the timeline. Okay, they did ask for notes here, but notes aren't often asked for in a exam paper question because all of it is disclosure. So they'd rather ask you to show that and then show working separately. All right, and how I've done my workings here is the same as how I would do in the exam. Okay, when I see dates, draw a timeline. Put everything on the timeline, and then it's so simple. Did I have that vehicle for the whole year? No, so I used pro rata. Did I have that vehicle for the whole year? Yes, no pro rata. Right, and I can do the same thing with mortgages, with loans, with whatever. Okay, it's very simple to see what's happening if you draw it up like this. Okay, that's what I do when I look at those questions. Okay. All right, so let's see if you can maybe look at some of these for next week and you can tell me how it goes. All right, exercise 6.2. That one you can use as practice. Okay, you don't have to do all of these in one day. Okay, that's too much. I would maybe do one, maybe 2 or 3 days from now. Okay, so maybe on Thursday, maybe do one of them. Okay, maybe do this one on Thursday to practice, to see, well, am I okay with my disclosure? Do I understand how to disclose information for a CC? You can see it's very similar to to sole proprietors. The only thing different with a closed corporation is what I highlighted here. Special disclosure, that's different, that's new. Okay, let me actually highlight all the stuff in color. The stuff that's not 1502. This isn't 1502. That stuff, okay, let's use a different color. Yeah, let's just use that. Okay, this is 1601. Okay, separate disclosure for a CC. All of these things you could have seen in 1502. This is also 1502. This is 1601. That's new. Tax is tax is new. All right, and then on this side, this is old stuff that you should know, that you should know, that you should know. The deposit, it might be new, but it's something that just looks at basics in terms of assets, liabilities, income, expenses, capital, and drawings. Okay, your accounting elements. This is new. That's new disclosure for a CC, specific to a CC. This is obviously new, specific to a CC. This is new, specific to the CC. This is new, specific to a CC. Okay, everything else, oh, here, the tax as well. Also new. Right, everything else, so those things I'm hoping you get right without making any mistakes, because that's 1502. All of this I would expect you to get right. Okay, obviously this you could get wrong, but it'll take some time and some practice, and then eventually it'll be perfect and you'll get it right as well. All right, so when you go through these questions, make sure you can get all the things that I haven't highlighted right. If you're getting those things right, you're definitely going to pass the question. Okay, to get your distinction, then you've got to work on the differences that relate to CCs. Okay, those things need to be looked at separately when looking at disclosure for a CC. All right, does that make sense? Are you okay with that?
Yes.
Okay, perfect. All right, so I'm going to give this to you as homework. Try it, see how it goes. Don't look at the solution. Try to do it like a practice question. Okay, practice is key. Okay, remember it's a practical subject. You're not going to study for the exam. Okay, you're just going to do past paper after past paper after past paper after past paper. Okay, at some point in time, you'll feel ready. And when you're feeling ready, then that's a good sign, because then we know, okay, you're going to do well, you're going to get your distinction, you're definitely going to pass. We need to get you to that stage. Okay, so to help get you there, try this. Maybe do it on Thursday or do it on Friday. But don't do it today because it's still fresh. Leave it, let it soak in a little bit. Okay, and then come back to a question and see how it goes. See how much of it you can still remember. Don't worry if you make mistakes. There's nothing wrong with making mistakes. After you've done the question, then you mark your solution. Then go look at UNISA's solution, which they will give you. Here's it here, and then tick all the stuff that you get right. And then that also builds some confidence, because then you can see, oh, I actually know how to disclose a lot of this. You'll see here, there's periodic. Okay, that's 1502. Okay, we spoke a little bit about this right at the beginning when we started this course, because I had to check, do you know your basics? If you don't know your basics, you're never going to get this right. Okay, but I know that your basics are good because you could do calculations earlier on when we had discussed the periodic in some detail. All right, but again, if you struggle with any of these things, all right, let me know next week once you've done all these activities, and then I can go through it with you in detail. Okay, all right, so I'm not asking you to do everything and expect you to know everything. If you do get stuck with some of these things, let me know, we can discuss it, we can cover it in detail. All right, but hopefully you get the majority of it correct. All right, does that sound good?
Yes.
Okay, yeah, practicing is important. Try to do as much of it as you can. Give yourself some time to do it. Don't do it today because it's still fresh. Leave it for a day or two. Come back to it. Okay, I see they've given you another one. All right, this one maybe do on Saturday or Sunday. Or even on Monday, next week Monday, before we have our lesson on Tuesday. All right, you can choose when you feel comfortable. All right, but again, give some time in between. So do the one, and then leave it for a few days, and then see, check it obviously, check it first, and then come back on another day, and then do another one, and see, would I be able to do this question in terms of disclosure? You can even do it electronically. You can use this template that I created here at the bottom. Okay, I'm going to leave this here. Right, so you can use it. You can take what, you've actually got the PDFs, but obviously electronic versions are probably better. If you're going to do it on Excel, then just use what we've got there. Okay, let's see if there's more, or if that's it. That's number 3. Okay, this is a long one. This looks like quite a hectic one. Okay, but if I look at their solution, periodic again here, I see a little bit of fair value adjustments. Okay, that we covered in the first week. That we can go over again if you're a little bit unsure. Right, that's revision, okay, from week 1 or week 2, when we spoke about adjusting investments for their fair value. Right, you'll see that somewhere in the question here. They'll talk about an investment, or they'll talk about shares, or they'll talk about something like that. Okay, the rest looks pretty straightforward. Loss and sale of equipment. That's an asset disposal. Again, more 1502. Hopefully you still remember how to do an asset disposal. Looks like you have to do one in this question. Okay, again, if you don't know how to do it, or if you don't get the answer, let me know. I will go through it next week. Okay, anything that you want me to cover that you don't understand, we can go through. What else do we have? Okay, then just disclosure here. Okay, what else do we have? Do we have more? Or is that it? Yeah, we have more. Okay, lots. All right, this one, you could even leave for a week or two. Maybe do this one next week. After Tuesday, maybe on Wednesday, maybe on Thursday, maybe even on Friday. Up to you. Okay, but you've got another one to practice. Again, it's the same thing. CCs, disclosure, loans to, loans from, and then a few adjustments. This one's not as long. It's a bit shorter. And then again, they give you a solution. Okay, so you can check all of this. Right, I want to get to past papers because you don't have solutions for those. Right, so those ones I can do for you, and I can create solutions for you, and then you can either redo them later on or do them with me ahead of time, either or. We can decide later on. Okay, is that it, or is there still more? Okay, that's it. All right, so you have 3 examples to do. 6.2, 6.3, 6.4. Okay, try do those over the next 2 weeks. Right, maybe do one this week, one next week, another one the following week. Up to you. Okay, or do 2 this week, 1 next week. It's up to you. But don't do it all in one go, because then you're not getting better at the process. Okay, I would spread it out. Okay, if I was you, if I was giving you some study advice, okay, spread it out. Do one, skip a few days, do another one, skip a few days. But when you do it, don't look at the solution. Okay, like what I've done it like I did it today. Okay, how I did it today with you is what I would expect you to do in terms of your preparation. Okay, draw up the template, which you've already got. Look at the question, don't look at the answer, do the question. Okay, obviously it will take some time once you get familiar with the disclosure. Hopefully it's better now, because last week we covered the disclosure, we spoke about it, we discussed the notes. This week you're actually seeing it for real. You can see the separate disclosure. That you can see. Even the loans. When I spoke about this in the notes, you have a PowerPoint slide on this. On the actual slide, you'll see me state there that this needs to be disclosed separately. All right, it was in the notes. Now you can see it. All right, this is a worked example. All right, as long as you can remember it, then hopefully you can redo it and you can recreate it as well on your own. Okay, is that all right? Are you okay there, Cheryl?
Yes. Yes.
Okay, awesome. Okay, so I'm going to end this session here. Not end. I'm just saying end study unit 6 here. Okay. How are we doing with time? Maybe let's take a 5-minute break and then we'll start the new section. I want to start the. Let me go back to the textbook. The companies.
Companies.
Okay, that's what I want to look at today. So I'm going to cover the PowerPoint slides. We'll go through the notes. We'll look at that. Okay, and then we'll look at maybe 1 or 2 of the examples. We'll see how many they've given you here. I see a few other things that they never had before. Debentures, I see they've covered here. Dividends, looks like they've got a separate note about that, which is good. Yeah, so I think they've improved this section a little bit, but we can see and we can go through it. All right, and then that we'll do the rest today, and then we can look at 1 or 2 examples depending on how far we get. Okay, let's take a break to refresh, to rest and to relax. It is 14:37. 1:45, is that all right? 8 minutes or so? 10 minutes?
Yes. Yeah.
Okay, perfect. All right, let's start again at 1:45. I'll leave the class open, so I'm not going to send out a new link. I'm just going to obviously pause the video. Learning Unit 7 in the actual study guide. So we have 7, 8, and 9 left to do. Today we can cover the theory, so I'll go through the notes, the PowerPoint slides, and then we'll go through what the textbook has here. The worked examples, we can cover some of them today, and then we might have to do a few next week, and then we've covered 7. Next week we'll definitely be able to finish 8. 8 is normally very short because it's looking at branches. The long chapter, the one that will take us a few weeks, maybe 2, maybe more, depending. is the cash flow. That one's the challenging one. That's the one where you have to remember all your T accounts, debits, credits, lots of journal entries, and so on. Okay, but we'll get there. That's the one where you'll probably find challenging. Most students do. The rest is not too bad. Partnerships, I would say, is a bit of a challenging section because there's so many different considerations. This is an easy section, the one that we just looked at before the break. CCs are simple that you'll probably do well in, and that's the question I would actually look at starting with in the actual exam paper. When I get the exam paper, hopefully they break it up into different sections. If it's multiple choice, it might be a little bit difficult to maybe start with one question and come back to another one. If it's given like a window by window basis, so you've got to answer question 1 before you can look at question 2, or that type of thing. Right? If it is open and you can start anywhere, then that's quite nice, because I would always do CCs first because it's the easiest section. It's definitely going to be out of a lot in terms of marks because of the disclosure. And it's a nice way to get into the exam paper, building up some confidence in your ability to obviously pass and hopefully do well. Okay, so companies also something that I would look at as one of the inverted commas easier sections. Okay, it's not such a bad section to look at because it's very similar to closed corporations because they're also separate legal entities, and you're going to be looking at journal entries, which are workings. And if you like your workings, then you'll find this section quite easy. Okay, before I go through the textbook, I'm just going to go through my notes because they're a bit shorter, and then we can go through this just now. Okay. First thing we need to look at, recap regarding the different forms of ownership. Right, so you have 4 separate forms of ownership. We have now reached the last one, companies. Companies are separate legal entities. You get public and you get private companies. What's the difference?
Public companies, mainly I know the shareholders are, or it's listed on the JSE, so
Correct.
anybody can buy shares into a public company. Private companies has its own board of directors, I think.
Yeah, it's a closed company. It's closed off to the public. So unless you
Yes.
know someone in the actual private company, it's impossible to buy shares in a private company because it's not public. Right? If it's a public company, they have access to the market. Right? So the JSE is obviously the stock exchange. Okay, so you can buy and sell equity in those companies. You can become a shareholder. It's public knowledge and information. Right, that's more disclosure in terms of reporting for large corporates or even small companies as well. But it's generally the larger companies that have listings listings on the JSE. Right. So when you're looking at a company, just remember it's a separate legal entity. Right. So do public and private companies pay taxes?
Yes.
Yes. Good. Do public and private companies have their own rules and laws to follow?
Yes.
Yes. Okay. Do private and public companies have a separate legal entity in terms of their personality? So are they a juristic person?
Yes.
Yes, they are. Right. So because of all of that, you then need to consider this, the background. All right. So in terms of disclosure, okay, if you do more advanced accounting, they bring in more of the disclosure stuff. Then you'll talk about like all those policies and things like that. And then they even start examining it and asking for that information. But that's only if you're going maybe like the CA route. Okay? Or if it's not CA route, you're going an accounting route. Right, then you'll look at more of that. Right? If you're not, then it'll obviously change focus slightly, and then you're using the information more than preparing it. Right, so disclosure is the preparation or the layout and format of the actual company's information. right? And you will see it when you look at other more detailed subjects where you look at something like an annual report. Okay, an annual report doesn't only have accounting. An annual report has a lot of other information as part of the actual report because the Companies Act, in terms of legislation, requires those companies to adhere to certain rules and regulations. Right? If they're a public company, it's even more onerous because the JSE has their own listing requirements. So now not only do I have to meet the requirements of IFRS and the Companies Act, but now I also have to make sure that I meet the requirements of the JSE because the JSE is not going to let anyone sell shares on the JSE, but only companies that meet the requirements will be allowed to sell shares on the JSE because they can raise capital. Okay, and obviously raising capital is financial management. That's a totally different subject. That's fin. Okay. When looking at accounting, this is all from the textbook. So if you've got a copy of the textbook, which I think they did prescribe for you for this module, they didn't prescribe one for 1502, if I remember you correctly from the first week. But for this one, you do
Yeah.
have a textbook. Is that right?
Yes.
Okay, great. Yeah, so if you go and look at that textbook, you'll see a lot of the background information. The textbook's very good. It talks about the listing requirements. It talks about like how companies are established. It talks about some of the like the details, the requirements in terms of how many people do you need to start this business. Okay, for a private company, you only need one person. One individual can start a private company, and that one individual can be the 100% owner or shareholder of that private company. Right, that private company still needs to follow certain rules and regulations in terms of the Companies Act. Okay, they won't have to follow the JSE listing requirements because it's private. Pty Ltd, private company. I'm not going to go through too much of this. The study guide will probably reference the textbook. They'll probably say, please go read about this or read about that, that type of thing. Right, some of it is important from an accounting perspective, but not all of it. What is important is the capital. Okay, so in other words, when companies sell shares to the public, right, we call that equity. Okay, equity financing. Right, so as a company, the company will issue its shares. When they issue shares, you'll see if you've read some of this in the textbook, you'll see they talk about authorized share capital versus issued share capital. That's just background regarding companies. Right, authorized means when you registered the company. In South Africa, you have to register those companies with the CIPC. Okay, that's the regulatory body that basically registers new companies in the country. It's like the Home Affairs, but for companies. Right, so for example, let's say when you were born. Okay, when you were born, your parents would have registered your birth certificate, or you would have been registered at the Home Affairs office when you were born, and your birth certificate would be given to you or provided to you. So the same happens with a company. Right, a company will have a inverted commas birth certificate, and obviously all those requirements are kept at the CIPC. Right, that's where you would go if you were looking at registering a private company or even a public company, but obviously that's at a later stage when the company goes public. Something else you need to consider, the benefits. Why would you ever want to register a private company? What are the benefits of a private company? Can you think of a few?
More capital?
Good. Okay, so funding is a very, very important consideration because think about a sole proprietor. Okay, one person. When we looked at partnerships, we said that those partners, A and B, are going to join forces, and then they'll have more capital in the form of money. Okay, so it could be financial resources that they pool together, or it could be human capital. In other words, the knowledge, the experience, the skills. Right, that was something we looked at when we looked at partnerships. Okay, here we're looking at a company as being a separate legal entity. So sole proprietors and partnerships don't have access to as much funds as a private or a public company would have access to. Right, public companies, large corporates listed on the JSE, they have the most access in terms of funding because they can raise capital either with debt or with equity. Right, debt would be loans, okay, so liabilities, and equity would be shares. Okay, in this module, you don't really look at that, okay, because that's more financial management. You look at this, the equity. Right, so in this chapter, in accounting, you're going to be accounting for the share capital in the business, which is going to be part of the business's ownership. Okay, it's their stake, right? It's the stake that you have in the company, right? So benefits besides more resources, what other benefits can you think of? There's a few others that you need to note that affects accounting, but we'll look at it just now. Can you think of any others?
For some reason, I'm thinking more like equal risk or
Elaborate.
so one person wouldn't run the full loss of the company.
Oh, okay, yes, that's fine. That's good. Limited liability. Did I write anything here? No, I didn't. We can write them down. Limited liability would be a benefit, definitely. Okay, but there is a limitation to that. So when companies are registered, right, in the eyes of the law, they have something called where they lift the corporate veil. Okay, and that's to prevent fraud and corruption. So just because you're a director or you're a shareholder of a company doesn't mean you can commit fraud and corruption in the company, because those companies can still be held accountable because of other forms of legislation, including King Code of Corporate Governance and that type of thing. Okay, King Code you're probably going to cover in some of your theory subjects, operations maybe, management, maybe some ethics if you cover that. I don't know. Does King Code ring any bell?
I think is it like King second?
Yeah, you get King 1, 2, 3, 4. They're I think they're
Yes,
even at 5 now, and I think there's 6
yes,
or 5 is coming out soon, and then obviously they're going to create more as they go. It's for corporate governance.
yes, yes.
Yeah, that's where they would have spoken about King Code, corporate governance. So in other words, ethics in business, basically. All right. So when looking at the benefits, there are lots of benefits, and if I'm looking at things from an accounting perspective, a benefit would be everything is separate. Right, and literally everything is separate. So when we looked at close corporations, members were, inverted commas, separate, but we still disclose them in the statement of changes in equity. Okay? If you've got a company, it's completely separate. Right? The company is literally running on its own. Okay, so it doesn't matter who owns shares in the company, that's irrelevant. Right? From an accounting perspective, the company is completely separate and it runs on its own. So the accounting records are completely separate. You won't see all the shareholders being described in the accounting records. Right, you'll see the main shareholders in terms of their weighting because that's the structure of the company. That's a little bit different. Okay, company structure. So in other words, you have a very large parent company and then you've got smaller subsidiaries, okay, smaller companies. Right, that's a little bit more, how can I say, advanced. All right, that will only be covered if you do more accounting. Those are the third year subjects, the 3701, but the FAC ones. Right, then they look at like consolidations, all those like more technical things. Okay, it's not necessary in terms of what we're looking at, but it's important to appreciate that it's completely separate. Right, everything is separate. Right, the whole business runs separately, and that's why when you look at companies, we're going to be focusing on this, the issuing of share capital, because this is unique for the business in terms of its accounting, right? Because now you're not going to have one owner. you could have many. You could have millions of shareholders. In other words, millions of owners. Right. The owner of a company is called what?
Shareholder.
Good, well done. Okay, don't confuse that with directors or CEO. The CEO isn't the owner. The CEO is the chief executive officer. They run the company on behalf of the owners, which are the shareholders. Right, so when we talk about ownership, we're talking about the people that actually hold equity in the business. Most CEOs do have share options, and most CEOs will have shares in the company. So the reason for that is because they don't want the CEO to make decisions that aren't in the best interest of the company. Right? And if you give them shares in the company, hopefully because they're also a shareholder now, they can make better decisions. Right? And that's the background in terms of the decision making. Okay, what's important to understand from an accounting point of view is owners are shareholders. And I think I've got a note about that here. Yes, I do. Okay, there's it there. What do we call their capital? Share capital. Capital is capital is capital. Capital will always have a credit plus. It follows the normal rule. So when you have a T account for share capital, the same thing will apply. You'll have a credit plus, you'll have a debit minus. When you are going to be issuing capital, okay, keep it simple. Let me go back to our Excel. Let's make another sheet here. Companies. Okay. All right. Just be careful. It's going to get quite big here at the bottom. I think maybe when I do the next section, I'll start a new file. Okay, but I'm just using the same file and I'm just adding to it. But you can actually scroll. If you click these little buttons here, there's navigation buttons. So if I keep opening up new tabs, then you can just scroll across in that. So yeah, don't worry, I'm not deleting any of this. It is there, but it just might be hidden depending on how big this bar is. If this bar is very big, like that, then obviously I need to scroll. See, like that. Okay, I'm just showing navigation. You probably know how to do that, but some students don't, so I'm just mentioning it. Okay, right, so I'm starting a new tab, companies. Okay, remember I like to keep things simple because then it's easy for you to understand, especially if you can relate to something that you're already familiar with. Right, so let's start sole prop. Okay, I want to know what am I going to do when I have this? What's the working for that?
So you would debit bank and credit capital.
Perfect. Okay, it's as simple as that. The only thing that we need to consider now, because you've got companies, okay, so when we have companies, okay, we need to consider the timing differences. All right, asterisk, because of the additional rules, regulations, red tape, all of that stuff that needs to go, basically the process. All right, so because of additional, let's just say process slash considerations slash, let's say legal requirements, okay, when issuing new shares, okay, new equity. Right, so share capital, capital. There we go. All right, so when you are going to be accounting for the equity within a company, right, because of the additional legislation, Companies Act, JSE listing requirements, etc., okay, all that background stuff, right, there could be a timing difference in terms of when you collect money from the public and when you issue the shares to those public shareholders. Right, so when you look at a company, to keep it simple, you will always have a debit for bank and a credit for capital because the asset is increasing and so is the owner's equity. Capital is increasing. Right, owner's equity is increasing. But because you have a timing difference. You'll have a working account. Right, so you might have received money from the public maybe on, let's say, 1st Jan. Okay, the public wants to buy shares in your company. Okay, later on, you allocate the share capital, and that might happen maybe on the 30th of Jan. Okay, a few days later, after all um, the shareholders have subscribed to those shares, okay, in terms of wanting to be a shareholder. Right, so this is important because of the dates. Right, so what do? You bring in a working account. Right, here's another working account to add to the ones that you already know. Okay, other working accounts that you know: profit and loss, appropriation, valuation. Okay, that one we looked at in partnerships. Okay, the one that we looked at more recently, liquidation. Right, a liquidation T account is a working account. Here's another one: allocation / allotment accounts. Again, it's just like a placeholder to keep record of debits and credits where there is a timing difference. Right, so if you look at my notes, you'll see I've shown that here. Okay, those are working accounts. Right, it could be called incorporators, but that's only when the company starts. Okay, a company is incorporated. Right, when the company is incorporated, that's the start. That's like when the baby's born. Okay, that's the birth. Right, so this is the birth of the company. Okay, application and allotment, that's during the life of the company. Companies can issue more shares as they continue to operate. Okay, but when they are born, okay, when companies are born, right, they will have a certain amount of shares that they can issue. Right, and that's where we spoke about authorized share capital versus issued share capital. Right, they can apply and they can change that, obviously in line with the rules and regulations of the country, but generally speaking, okay, there will be a set number of shares available to the company to sell to the market. Right, and it could be millions. Maybe a company might have 10 or 100 million shares that they can issue. Right, and they can issue those shares whenever they want to. Right, if they issue shares later on, then you'll have an application or an allotment account. It doesn't matter what you call the account. If it's called incorporators, if it's called application, allotment, whatever it is, it's just a working account because that credit will eliminate with that credit. You basically cross it out. And what are you left with? You're left with what we had earlier. You're left with a debit for bank and a credit for capital. All right, so keep it simple. Don't overcomplicate it. Try view it like how I viewed it here, and then just remember, if there's a timing difference, split it and add the working account. Obviously, you're going to credit the one and you're going to debit the other. And that's it. It's as simple as that. Right. Obviously, you will see more detailed examples where you'll have different steps maybe. They might talk about an over or under subscription. Those are common things that comes up in this type of section. Okay, let's go back. Next slide. Owner's equity. Will there be costs associated with issuing shares? There always is. Right. Who are we going to pay? We're going to pay the banks. Right. Banks, okay, the large banks, the investment banks, they help with IPOs. Do you know what an IPO stands for? You saw it on the previous slide. Any idea?
No idea.
No idea. It's over here.
Is it like international? Oh, initial public offering.
Yes. Okay. What does that mean? Initial public offering means we have a private company, okay, going public.
Oh, okay.
All right. The initial public offering is the process that takes place where a private company lists on an exchange and they become a public company. And that's the first step. Okay, happy with that?
Yes.
Good. All right, so when you have an initial public offering, who assists with the IPO? The investment banks. Okay, those investment banks help with those IPOs. Right, that's their role. They're part of the financial sector, and as part of the financial sector, investment banks help companies list on an exchange. Okay, that's part of their role, right? They're an intermediary. They assist with transactions, right? So, will there be a cost associated with issuing shares? Yes, right. The IPO will carry a cost, and the business will have to pay the bank a fee, okay, or a commission, right? When you are going to be charged a fee, it's simple, right? Who pays the fee? The business. Okay, so how are you going to view the costs? What type of accounting elements?
Expense
Good.
increases.
Okay, what balances do expenses have?
Debit.
Yes. Okay, so how do you account for those costs? Well, if you have issue costs when you're selling shares or raising capital, you would record an expense. You would record a debit against the share issue expenses. And if you're paying those expenses, your bank will obviously be affected negatively. Right. You can also have an underwriter, which can be part of this scenario. Okay, an underwriter is a bank generally, okay, that helps with the initial public offering, but they're looking at unknown companies. All right, so let's say we had a private company, PTY Ltd, and let's say the private company was called, let's just call it ABC. Okay. Does anyone know ABC? No. Okay. Let's look at an example where you do know some of these companies. Let's talk about Facebook. Right. Facebook went through an IPO back in the 2000s. Okay. I think it was 2004. You might have to Google and just double check that, but it was somewhere around there. Okay. I think 2004 was the right date. We can double check it, but do I have my, yeah, I do have Google open. Yeah, I just want to make sure it's correct. I don't want to give you false information. Okay, Facebook IPO. Let's see. Facebook IPO. Oh, I think 2004 was the start of Facebook. I think I've got my dates wrong. Okay, 2012 was when Facebook had its initial public offering. All right, there's the right date. All right, I need to correct that. Okay, so IPO was in 2012. Okay, 2004, I think that was the birth. Let's go back and check that. IPO, Facebook, let's say founding date. That should bring it up. Yeah, there's it there. Okay, I knew there was 2004 somewhere. Yeah, 2004 was when Facebook was started. Right, 2004, would you have, yeah, you probably would have been around by then, because if you're studying first year, you are around 18, 19, somewhere around there, and this is 2014, yeah, so Facebook is not even 20 years old yet. Facebook is only 16. Okay, Facebook was founded by Zuckerberg in Feb of 2014, okay, in a Harvard dorm room. Okay, maybe you're a fan of documentaries. I think I might even have shared some of this with you in a previous discussion, but for something else. But The Social Network. Okay, I know I haven't mentioned this, but maybe you've seen the film. The Social Network is basically about the start of Facebook, how Facebook was created. Really entertaining, and shows you the backstory of how Zuckerberg and his friends had started Facebook from a dorm room at Harvard. Right, and that was obviously created in 2010. Right, so coming back to what we said here, 2004, let's correct the dates. This was when Facebook started. Okay, when Facebook started, it would have been a private company. Right, Facebook listed on the New York Stock Exchange in 2012. Okay, so 8 years ago. Right, that's when Facebook went public, IPO. Right, so when you have an IPO, sometimes you don't have a problem selling shares in a company because everybody knows the company. If you're ABC Pty Ltd, no one knows ABC. Everybody knows Facebook. Do you agree?
Yes.
All right, so an underwriter is there to help with the issuing of shares. That's their role. This is important, and that's why I'm trying to describe it with a bit more detail, because you will see underwriters in different questions, okay, when they look at IPOs, when shares are being issued. Sometimes shares are issued, and an underwriter is underwriting the issue of those shares because there might be a risk in terms of not raising enough capital. Okay, there's a reason why I've got the slide here. Okay, we spoke about raising capital in the market. We said public companies have access to lots and lots of funds. Public companies can sell shares to the public. Okay, they can raise capital. Right, so if they do that, obviously there's a level of risk attached to it, because sometimes you don't have any buyers for those shares. No one wants to buy shares in ABC. Right, everybody wants to buy shares in Facebook, right, because it's a well-known company. And that's why when you have this scenario, an underwriter is used to ensure that the subscription, okay, when you're selling shares, that the full subscription, that it's fully subscribed. The subscription is fully subscribed. Right, because you want to raise capital. You want to sell X number of shares in the market, and people are going to pay X amount for those shares. Right, so Facebook did that back in 2012. Right, and Facebook was listed at around $34 a share. Right, that's when they listed back in 2012. Right, obviously, Facebook was a private company before 2012. Question mark. Who knew how much Facebook was valued at before 2012? No one knew. All right, so what happens when no one knows how much a company is worth? Well, then you get the experts in, okay? And the experts are investment bankers, okay? Those people do valuations and calculations, okay, to determine how much something is worth, right? And then they make a decision, all right? If we're going to sell Facebook shares, how much are we going to sell Facebook shares at? Right, before they listed, Facebook shares were, there was a debate. No one knew. Was Facebook going to get listed at $100 a share? Was Facebook going to be listed at $20 a share? Okay, it was a question mark. Okay, it was settled on $34 a share. That was what the investment banks were willing to issue Facebook shares at in the market. Right, and you can actually go find this information. It's publicly available because these are public companies. With public companies, you can find information on those public companies anywhere in the world, okay, because it's public, right? You, if you wanted to, could buy shares in Facebook if you believed in Facebook and you wanted to be an owner or a
Just
shareholder.
a question, Anthony.
Pardon?
Just a question.
Yeah.
Do you by any chance buy shares?
Yes, of course. You have to diversify your portfolio. So it's important to diversify. This is something that you learn about in INV. In INV, they talk about portfolio management and diversification. So if you're saving, remember, most people save money in a bank account.
Yes.
Okay, so cash. Right, at some point in time, you move to other things. Then you might move to maybe like a money market or a unit trust. Right, and then you might move to something else, maybe property. Okay, bonds also fall under this section. And then you can move to other things. Equity, it's risky, but over the longer term, shares outperform any other asset class. Okay, and you can go look at the research and the data. In investment management, they'll even teach you that. Okay, they show you some backgrounds regarding equity, asset valuation. Okay, shares over the longer term. Okay, so you're not going to buy and hold shares for 2 months, 3 months, 4 months. Okay, that's risky. Right? Some people do, but it's not ideal. Okay, ideally, if you want to consider equity shares, hold those shares for 5 years plus. Okay, because then you're going to see some sort of return on investment. Right, but see, that's diversification. Right? Obviously, you're not going to want to keep all your resources in 5 year plus investments, okay, because that's risky. Because now what happens if you need some cash because you have something that you need to pay for in the short term? All right, so it's just an asset class. It's like buying any other product. So when you look at the markets, which is what we're looking at here in terms of stock shares, okay, companies All right, so give me some examples. What companies do you like in South Africa? Large South African companies.
I always stick to the bank. Okay. I just wanted to ask you something. Which platform do you use to buy shares?
Okay, there's lots. You can buy shares using most banks offer platforms that you can buy equity. Okay, shares, and it's better to use one of them because it's heavily regulated and your funds are safe. All right. Obviously, the bank's not going to secure your losses. So obviously, if you buy Steinhoff, okay, Steinhoff obviously went through a whole bunch of bad scenarios. So if you bought Steinhoff when Steinhoff was 300 Rand and now Steinhoff is 2 Rand, okay, the bank's not going to cover your loss. Okay, that's your
Yes.
problem. Okay, if you bought a bad company, that's your bad investment management. Okay, but the bank will regulate and make sure that your funds are safe. So whatever funds you have in that account will be protected and will be safe. And all the banks offer that. Okay, most of the big banks offer an equity account that you can open with them, but that's only if you're going to manage your portfolio yourself. Right. Ideally, you'd probably look at unit trusts because those are managed funds. Someone else is going to be buying and selling those shares. All right. So unit
Okay.
trusts are more conservative. Okay, slightly less risky. You do get more aggressive unit trusts that are more high risk, obviously because they have more exposure to equity. Okay, but that's more investment management type considerations. Okay, but to answer the question, yeah, all platforms offer, all banks, I should say, offer platforms where you can buy and sell those equities. Okay, even some of the what do you call, what's the right word? Asset managers, not well, not quite. The insurers. Okay, like for example, Sanlam. Okay, Alexandra Forbes, all the asset managers, even Investec will have their own platforms, right? All the banks offer it, all those financial providers offer it. Okay, you can just go Google and search um, probably online trading accounts. Okay, and then you'll probably find
Okay.
one. But again, you want something that's regulated because you don't want to lose capital unnecessarily. So if you're looking at that as a potential, let's say, asset class that you want to start considering, then you would look at either at a bank or another reputable financial provider, right? Something like a Sanlam, an Investec, whatever. Okay.
Okay.
All right. So just coming back to the discussion, we had a note here about a company. Give me a company in South Africa.
Can I stick to a bank?
Yeah, anyone. It doesn't matter.
FNB.
Okay. All right. So if we're looking at FNB as a company, what is FNB going to do? Well, they want capital. All right. FNB can sell shares. Okay, and they're going to sell shares on the JSE. Okay, the JSE is obviously regulated. So again, a little bit more peace of mind there because any company that's on the JSE will have certain requirements they need to meet. Okay, we spoke about that earlier when we looked at those listing requirements and the Companies Act and all of that. Okay, so FNB is going to sell shares on the JSE. Right? If they're going to sell shares on the JSE, you're going to have lots and lots and lots of different buyers. They could be people, they could be large funds, okay, huge asset management funds, okay, unit trust type things, asset managers. They could even be other companies buying shares in that company. It all depends. Okay, but the point is, when FNB is going to be issuing those shares, they need to account for the share capital. And that's what you're going to be looking at in this section. Right, so the first thing you need to consider is, do they have to pay someone to help them with that issuing of shares? An underwriter will only be involved when you're issuing new shares and there's a risk, probably IPO, definitely, and maybe new issue. All right, so that's a risk. And then the underwriter would provide you with the equity because do you want to sell all those shares? Yes, because they want to generate all that capital. They want capital. Right, so if FNB sells maybe like 1 million shares, Okay, let's say they issue 1,000,000 shares, right? And F&B share price 60 Rand. Okay, so F&B will sell 1,000,000 shares at 60 Rand a share, and then F&B will generate 60 million. Right, but you know F&B. Okay, F&B is a popular company. Okay, what happens if you didn't know this company and the company wanted to issue shares and they also wanted to issue shares at 60 Rand a share? Right, are we going to buy shares in the company? Probably not. And that's where the underwriter comes into it. Right, so just remember the role of an underwriter. The underwriter takes on risk. Have you covered any of the risk modules? Have you done RSK 2601 yet? Or are you going to have to do it?
No.
You don't have to do it.
Yes. I have to do it
Oh, you have to
next
do
year.
it. Okay, but you haven't done it yet. Okay, yeah. So
No.
in risk management, they do talk about underwriters as well. But underwriters in risk management it's a little bit different. That's when you like take out a policy. Okay, so maybe if you've taken out life cover, okay, and then you have to fill out all those medical checks and all of that stuff. Okay, that process is called underwriting. Right, but that's from an insurance point of view. Okay, when we look at it from a investment or finance point of view or an accounting point of view, the underwriter is looking at the risk associated with the issuing of new shares. That's what you're looking at. Okay, and that's what we're going to be focusing on. All right, so how can you issue shares? Well, there's a few ways that you can do it. One of the ways is issuing additional shares from retained earnings. They talk about this as being a capitalization, okay, or a rights issue, depending on which textbooks you're reading. Right? If it's a finance textbook, okay, rights issue, capitalization issue. Okay, accounting, you're obviously looking at that, retained earnings. Okay, so when I have retained earnings, what did we say retained earnings is?
It's the profit that's still in the company.
Okay, good. And what type of account is it?
Capital?
Yes, good. Owner's equity capital, good. Right, so if you've got retained earnings and you're issuing additional shares, sometimes you can do that using this consideration. Capitalization issue, I'm going to give 1 share for every 4 held. Right, those are the type of questions you'll see where you have this rights issue. Okay, so in other words, if you're an existing shareholder, you are going to get more shares in a particular company, okay, because they have chosen. It's a business decision, right? Directors need to, shareholders need to vote, and directors obviously have to carry out those wishes, okay, carry out those duties, okay, of the company, right? So if you're issuing new shares from retained earnings is capital. How do you decrease capital accounts?
You debit it.
Exactly. And that's why you've got that. Right, and what are you doing? You're issuing additional shares. So how do you record more share capital? Well, you have to credit the capital. Does that make sense?
Could you just go over it again, please?
Okay, what is capital? Capital is money that the owner has. Okay, the owner's entitlement. Do you agree?
Yes.
If it's share capital, it's still capital, right?
Yes.
Okay, so how would you increase or show more capital? You would have to credit the share capital.
Credit it.
Okay, I'm issuing shares from retained earnings, meaning I'm giving existing shareholders more equity in the company based on our retained earnings. So if you're going to be issuing shares from retained earnings, will the retained earnings go up or down?
Down.
It'll go down. How do you decrease a capital account? You have to debit it.
Yep.
Right, so there's the basic working. Debit retained earnings, credit share capital.
Okay.
Okay, you're increasing equity and you're decreasing equity, but you're doing it using shares. Okay, you're using equity. You're changing profit into shares, right? Because of a decision that the directors have taken or the shareholders have voted on. Okay, all right. So when raising capital in the market, can all companies raise the required capital? We just spoke about it.
Yes and no. So public companies can.
Even if it's a public company, if you don't know the company, is the company going to sell shares?
No.
Okay, correct. So when raising capital to the market, sometimes no one wants to buy those shares. Right, so who did we say is going to help with the risk of this event? So in other words, wanting to sell shares but not able to sell shares.
The underwriters.
There we go. Good. Okay, add that to your notes. Underwriter is the key word. Okay, that you'll see a lot in different examples. Right, when it comes to tax, we spoke about it earlier. Companies and CCs are separate legal entities. That you should know. So are companies also separate legal entities?
Yes.
Yes. Okay, what does it mean to be separate?
Can I say employees are just numbers?
That's actually, yeah, you've got a good memory. You're recalling the close
So
corporation thing.
basically,
Yeah. Okay, it's a good
yeah, so
answer. I
basic
didn't expect that answer word for word. That's brilliant. Wow. Okay, I was
so
expecting
basically
something along the lines of because it's separate, it would be standalone. So those companies, FNB. How old is FNB? Do you know?
no idea.
No
I can
idea. Let's
check.
search for it quickly. I'm thinking maybe about 100 years old, maybe a bit older. I think First Rand is probably the old. First Rand is obviously the holding company, but obviously FNB is a separate company because it's a bank now, not all the other insurance and stuff like that. Let's
It
just
says
see.
182.
There we go. FNB founder founded 1882, 1838. I'm getting 1838, Grahamstown. That's what I'm getting here.
Yes, so 182 years.
Oh, okay. You're looking at the age. You're
The
182.
years.
Yeah, so 1838. That's
Yes.
that's old. 182. Do you know anyone that's 182 years old?
No.
Okay, so that shows you that when looking at this, they are continuous. There is continuation. Continuation. There is legacy. Right, when you have a company, companies can survive and last a very, 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 very long time. FNB might even be around for another 182 years. Who knows? Okay, but the point is, companies have continuation. Whether you own shares in the company or someone else, it doesn't matter. Okay, the shareholders, it doesn't matter who owns those shares. Right? Yes, it does matter in terms of voting power and that type of thing, but that's a completely different discussion altogether. Okay, we're not going to get into that. What we're looking at is the accounting record keeping. So when I look at a company, the accounting will always be based on a going concern. Okay, and will you have tax implications for a company? Yes or no?
Yes.
Good. Okay, what are the tax implications? Do you know? Same as what we saw in the CCs.
So the company will have to pay tax.
Yes, independently. Oh, I didn't write it down. It was on the other slide. I think I wrote on the CCs separate tax calculation, something like that. Separate tax calc. Okay, pay tax separately. Right, do you remember how much tax companies and CCs pay?
I think you said 28.
Very good. Yeah, wow. Your memory's amazing, I must say. Sure. Most people don't remember a lot of the detail, but yeah, you seem to, which is good. Yeah, so 28% is the flat rates for corporates in the country. Right, corporates are huge businesses, big businesses. All big businesses have to pay 28% tax, and it's a flat rate. So on the first rand that they generate, every rand that they generate in terms of ongoing operations, okay, is taxed at 28%. Right. For smaller companies, so private companies, you do get certain benefits, but that's SMMEs. Okay, small, medium-sized businesses, okay, enterprises, right? And that's a little bit different. That's tax. Okay, those are tax modules. Okay, but for us, in this subject, I actually haven't seen UNISA ever give a tax rate to work out a percentage of. Like, I don't know why they don't. They could, but they don't. They always give an amount. They always say, this company is going to pay this amount of tax, and then you just got to consider it. So you don't actually have to worry about the rates. But the rate has been 28% for many, many, many years. Right, government has changed other tax rates, but just they haven't changed this one for a long time. It used to be 29 actually, and then it was dropped to 28. But now it's been 28 for many, many, many years. From an accounting point of view, what do we need? We need two accounts. One account is going to be a liability in terms of disclosure. Okay, and that's what we spoke about earlier. Okay, SARS tax liability or tax payable. In terms of operations, before tax, after tax. Right, you will have to show that. Same as your CC, the one that we just did before the break. Okay, you saw my disclosure where I showed the before tax, then I said less tax. The same thing will happen here with a company. Companies also have to show tax, and companies also have to pay tax. Okay, here's your new vocabulary. This one you already know. Share capital. That one you also already know. Same as CCs. What is it? It's capital. Okay, do you know what we call profits that are distributed to shareholders?
I'm going to go with dividends.
Yes. Okay, so the shareholders are the owners. What do we call dividends then? It's a form of drawings. Right, but be careful with this though. If you're looking at drawings we know is what? Owner's equity. Do you agree?
Yes.
Okay, where do you think we're going to disclose dividends? I've put a note here, inverted commas, expense. Okay, the reason why I've done that is because the dividend is paid out from the profits of the business, but it's paid out after they've worked out the profit. So you don't pay dividends before, you pay dividends after. It's seen as an expense, but it's not quite, because companies talk about paying dividends, and they pay dividends to these third parties, okay, these owners of the business. But it's seen as drawings because it's disclosed as part of the statement of changes in equity. But remember, the SOCI is always going to be looking at owner-related transactions. Right? It's always been the case. In partnerships, SOCI, same thing. We looked at owner-related transactions. Okay, so salaries with partners, interest on capital for partners, drawings by the partners, etc. When we looked at members' contribution, okay, when we looked at CCs, same thing applied. Owner-related transactions, where did they go? They went straight to the SOCI, right? And that's something that you can always remember. It doesn't matter what type of business you're looking at. You're always going to show owner-related transactions in the statement of changes in equity, because that's what the statement is there to do. It's there to show who gets the profit. Right, do you have to pay out all the profits?
No.
No, you don't. What do we call the profit that we don't pay out?
Retained earnings.
Very good. Right, so when you do a calculation, okay, when you look at profits, right, a portion is paid out and a portion is retained. Right, so retained, that would be the retained earnings. Payouts, that would be the dividends. Right, so profit, there's a question mark there. Companies decide to either pay out a profit or not. Right, and maybe if you were following the news during COVID, a lot of companies had chosen to not pay out a dividend. You can go Google and you can go search for some articles. Right, there's a lot. You'll find many. Okay, during COVID, during the lockdown, most companies chose to either pay out a very small dividend or not pay out a dividend at all. And the reason for that is it's uncertain. They don't know if they can continue operating in the future. So they'd rather keep the retained earnings within the company because then the company can still survive. Okay, if you're paying out all your profit, you're paying out all the cash. Okay, because the cash isn't in the business, it's outside because it's paid out. So dividends aren't always paid out. Dividends can be paid out, but a lot of the time, a portion of it is kept inside the business because that's why
Just
certain businesses can still survive. Okay, even though we have a huge recession and like the GDP had declined by I think it was what 50% or something like that. Okay, there's something crazy like that. Businesses are still going to operate. Okay, because hopefully those businesses have enough retained earnings, profit that they've kept aside from the good years that they can use in the bad years. Right? And that's what makes a company sustainable. Companies are sustainable when they have cash flow. And that's something that you'll learn about in the last chapter, chapter 9.
just a
We'll look at
question.
cash flow.
Dividends, would we disclose it in our SOCI or statement of financial position?
It's disclosed in the SOCI, but the liability is disclosed in the statement of financial position. Okay, good question. We can actually add that to the notes here. All right, I had liability. Liability and assets go to the statement of financial position always.
Yes.
SOCI, owner related transactions. So the dividends that are paid, notice the words I'm using. Dividends that are paid out will go to the SOCI. Dividends that are declared is payable. Okay, so companies declare a dividend and then they pay the dividend. Again, it's timing. Okay, you don't declare and pay
Okay.
the dividend all at once. Okay, remember with companies, they've got lots and lots of regulations and rules that they need to follow. Right, the JSC is not going to allow them to just declare a dividend and pay the dividend immediately because it needs to be screened, it needs to be checked, it needs to be in line with the rules and regulations. Right, so there's always a timing difference, and that's why you have all those working accounts. Right, so if a dividend is declared, it's payable. Payable means we're going to pay it, but just not now. Okay, if it is paid, then bank will obviously be affected. Does that make sense?
So payable is similar to a creditor.
Yes, if it's payable, it's still going to be paid. It's like an accrued expense. It's similar to a creditor.
Okay.
Yeah, a creditor would be trading other payables. That's right. Okay, are you happy with the
Okay.
context? Are you happy with the theory?
Yes.
All right. There's a lot of theory, and obviously I'm trying to just limit it to what you need in accounting. Right. If you do have time and you can go and read through that textbook, it's brilliant. Right. The textbook gives you a little bit more insight or depth to the discussion. Okay, I'm trying to give you some of it now by discussing it in context and to highlight the more important points. Right. What you need to know from a fac1601 point of view is what you have on these slides. Okay, you don't need to go too deep. Okay, we'll go deeper if you need to when you have a specific subject that requires more depth. Right. So in INV, okay, we do have to go deeper in some scenarios. Okay, and same with fin. Okay, with finance, you have to go deep in some scenarios. Right. For accounting, it's just that. It's debits and credits. That's all you need to know. So as long as you know what share capital is, as long as you know what retained earnings is, as long as you know what a dividend is, you'll be fine. Okay, for this subject. Happy so far?
Yes.
Okay, great. All right, then the last bit here, just a few other considerations in terms of vocab. Right, jargon, stuff that you will see in this particular study unit. Issuing debt securities or instruments. Remember you had this slide here? And I spoke about debts.
Yes.
Okay. Do you recall those notes that I had given you where you had debentures? Do you remember what a debenture is?
Yes, it's when say if a company needs a loan, FNB for like a huge amount, one bank wouldn't give them that loan, so it's like a split loan that they get from different sources.
Well done. Good answer. Okay, and that's exactly what a debenture is, and that's why you've got this note here. Okay, so when you have debt instruments is another way to raise capital, and companies have different debt instruments. The general name for them would be financial instruments, right? And banks create these things, right? So you might have heard of a bond or
Yes.
bonds. Bonds are issued by companies. They're considered financial instruments. They're actually debt instruments because it's based on a loan. A bond is a loan. It's an IOU type arrangement. Right, so you'll see some of that in accounting. Okay, sometimes you'll see a long-term loan or a bond or even a debenture. Okay, that's why I've tried to put that there. Right, so these are some of the more common terms that you will see when you talk about companies. It doesn't matter what name I give this thing, it's always going to be seen as a liability. And that's the important bit from an accounting point of view. Okay, a loan is a loan is a loan. A loan is a loan is a loan, and I can just call it something different or package it differently. Right, so a loan could be a debenture. A loan could be a bond. Okay, but at the end of the day, it's still a loan and it will be a liability. Right, so it will follow the rules of a liability. If you are going to be raising capital means getting more money. Can I get more money through debt? Yes, I can. What do I do to the liability? I increase the liability. What happens to my money? It increases because I've raised the capital. Well, are you happy with that debit and credit?
Yes.
Okay, it's very simple. Just think about it like a normal loan. When you did 1502, you would have debited bank, credited loan. Now that you're in 1601, you could credit debenture, loans, or bonds. The name has changed, but the basics stay the same. Happy?
Yes.
Okay. What happens if interest is due on that loan?
It would be an expense.
Good. What would you debit? What would you credit?
If they pay it, I would debit interest expense or interest on loan, and I would credit the bank.
Well done. And if you don't pay it and it's outstanding?
Accrued expense.
Well done. Brilliant. Good answer. Correct. There's the note. Debit the interest, and remember, it could be interest on any of these things. They're just different names for different liabilities. It could be interest on the bond, interest on the debenture, interest on the loan, whatever it is, it's still an expense. And you're recording an expense. Right. What you said was correct. If you pay it, you'll credit the bank. If you haven't paid it, you'll credit the liability. Or, there's that word again, capitalized. You actually saw that in that example we did earlier. Remember? They said the interest is capitalized to those loans with those members. Remember that?
Yeah.
Okay, and the word capitalized means to add it to the balance of the loan. Okay. All right, that's it. That's the end of our additional PowerPoint slides. I'm just going to wrap up and I'm going to look at the last, I'm going to spend the last 10 minutes looking at the learning unit. I just want to go through to see what UNISA has given you in terms of their notes. They've given you an introduction here. Okay, key concepts important to understand. Right, we've looked at the differences between public and private companies. That's important to understand. The one that you'll be looking at is this one, the public company. Shareholders, you should know what they are. Issued and authorized. Remind me, I spoke about it earlier. Tell me what it is. What's the difference between authorized share capital and issued share capital? Do you remember?
I think, but did you name it authorized or did you name it declared?
No, authorized is right. Declared was for dividends. Dividends can be declared and then paid.
I don't know.
Okay, authorized share capital is what they can issue.
Oh, yes, and you said 10,000.
And that's CIPC. So when they register, if you go deeper, you'll see there's a memorandum of incorporation. Right, that's highlighted as part of the requirements when a company is registered. When the company is registered with the CIPC, there will be a certain amount of capital that they can issue. They don't have to issue all of it, but they can issue it. A company will normally keep a lot of the share capital inside the company, and they'll only issue some of it. When you issue the share capital, that's when you get shareholders. Right, so shareholders hold the issued share capital. Shareholders don't hold the authorized share capital. There's a difference. Is that okay?
Okay. Yes.
Okay, good. All right, share capital account is like any other capital account. You're just naming the capital, share capital, because you're dealing with companies. Ordinary shares, preference shares, different types of shares that you can have in the market, okay, based on the voting rights, okay, or the rights to dividends. I'm just going to write dividends question mark. Right, dividends are paid out to preference shareholders first before ordinary shareholders. It's just different hierarchy. Okay, you either have more rights or less rights in terms of getting paid out a dividend or in terms of voting. Capitalization shares we spoke about when we looked at a rights issue. There was a note about that in your slides. Underwriting, we spoke about an underwriter. The underwriter's job is to make sure that the company that's issuing shares is going to have a fully subscribed issue. In other words, they get the capital that they want when they sell shares. Interim dividends. Dividends can be paid out during the year. And a final dividend is when the dividend is paid out at the end of the year. Right, remember, how long is the financial year? 12 months. Okay. That's the start. That's the end. Right. 6 months down the line, there could be an interim dividend. And then at the end of the year, after the year is completed, then there'll be a certain amount of profit. Just remember, a dividend is a payout of profit that we spoke about. Okay, these are key concepts that you need to know when you look at this particular chapter. Right, and then debentures we spoke about, you described it perfectly. Okay, it's like taking a big loan and splitting it up into smaller loans, basically. Okay, I see Unisa has given you actually quite a bit of background. This is quite good. You can obviously read through this. It's just going to give you more insight in terms of how a company is structured, how a company is run, and some of the benefits here. They've also spoken about raising capital here, the continuing existence of the company. Okay, remember? Limited liability, separate legal entity. Okay, here's some theory that you can have a look at. Okay, characteristics of companies. Companies generally make a profit. Companies can also make a loss. How do you work out profit and loss? Do you remember?
Like net profit or gross profit?
Just general. How would you generally work out a profit or a
Income,
loss?
income minus expense.
Very good. Okay, yes, then you can be more specific if it's gross profit or if it's net profit. Good. All right, here's some notes about the formation of a company. There's the Memorandum of Incorporation. There's the CIPC. Companies and Intellectual Properties Commission, CIPC. I think they made a typo here. That should be CIPC. Okay, it's not a commission, it's just the CIPC. Okay, let's see. Types of companies. Okay, a little match the column exercise there. This is all theory. Shareholders. Who are they?
The owners.
Very good. When we talk about companies, that's the word we're going to use to describe them. Okay, we're not going to talk about members or partners or sole proprietors. We're talking about shareholders. Shareholders will hold a certificate, a security or a share certificate. That gives them the right to vote. That gives them that entitlement. Okay, they own that share, that they own a piece of that company. Right, when you asked me earlier about those shares, when you buy those shares through those banking platforms, right, those banks offer those online share trading platforms. Right, when you buy those shares on those platforms, you are the direct owner of those share certificates. Right, so if you like FNB, okay, and you open an account and you buy shares in FNB, you actually own a portion of FNB. Right, it's a very small portion. Well, it could be a large portion depending on how much you've invested, but the point is, you're a shareholder. You have a right to a share of that profit, right? So any dividends that they declare, you get a portion of that. Okay, that's what they've described here. They talk about rights of a shareholder, right? You have voting rights and you also have a right to profits or a share of the profit. There's the word dividend that I want to highlight and circle. Payout of profits. Okay, share transactions we'll look at next week when we look at example exercises, okay, where you've actually got debits and credits. This is something that we looked at when I spoke about an IPO, okay, initial public offering. I didn't mention the perspective because I didn't know how much detail they're wanting you to know, but I see they've given you quite a bit of detail here. So I'm going to discuss it. I'm going to highlight it for you. Okay, remember we said who helps with an IPO? The investment bank. What is the investment bank helping with? Issuing shares in ABC Limited. Okay, ABC is a company that wants to sell shares. Right. The investment bank is going to help create a prospectus. A prospectus is like a marketing. It's like a brochure. Right. It's like a marketing tool. It's basically giving information about the company before they list, and then shareholders, you and I and other people or other companies and businesses, they will decide whether they want to invest or not based on this prospectus. Okay, so a perspective is just a way to present information to the market so that the market is aware of how much those companies have in terms of assets and liabilities and so on. Right? It's literally it's kind of like putting your best foot forward. Right? If no one knows ABC, now we need to get people to know who ABC is. Okay, we need to issue a perspective. We need the public to buy into this prospectus, right? To have perspective on whether this is a good or bad investment. All right, what else do they give you? Okay, just more references to the textbook. Okay, dividends you should know. We spoke about it earlier. I even wrote it down on that previous slide there. I'm going to write it down again. Payout of profits. And you don't pay out everything, you pay out a portion or a percentage. The rest you keep inside the business. What do you call profit that you keep inside the business? Do you remember?
Retained earnings.
Very good. That's the correct answer. Nice. All right, there's the note about debentures. Okay, this I think they've added. This is quite different to some of the older study guides. This actually used to be covered in 1502, but it was a short section. Obviously, it was taken out of 1502 because you didn't know what that was when I had discussed it. And then we covered it at the beginning of this course when I looked at the investments. Okay, and the fair value adjustments. Remember that?
Yes.
Okay, that was when we covered this. We spoke about debentures and how we provide for it. All right, so this is good. I see it in the textbook as well, so you can always look at that for additional information. Keep it simple though. Don't overthink it. A debenture is just what?
Hello?
Yes, and a loan is a liability. Do you agree?
Yes.
Okay, that's the key. All right, annual financial statements. Very, very, very similar to what we saw in a CC. The disclosure for a CC is almost identical to a company. For a company, it's even easier because you don't have members. You don't have loans to members, loans from members. You don't have any of that. Okay, it's simple, basic disclosure showing the operations of the business, the equity of the business, and the financial position. Okay, that's where we're going to stop. Right, I don't want to start with this week. There's no time. I'm going to cover this next week. We can start with it. Right, no homework for next week. The only homework is just to practice. Okay, when I talk about practice, try to do some of those close corporation examples if you can. It will help you later on. Okay, when we do more of those examples, I'm not going to, well, I can do those if you want me to, but I'd rather just discuss things that you don't understand and then cover those sections than have to do those whole questions. They do take a long time to complete. I'd rather have more time to do the past papers. Okay, that's where we will see the close corporations. We will definitely see close corporation disclosure questions in those past papers, right? And then I'll revise and I'll cover more of those practical questions with you when we get to those past papers. Right. So no real homework other than those close corporation questions that we spoke about earlier. Try to do as many of them as you can, or all of them if you can, but don't try to push too much in terms of trying to do all three in like 2 or 3 days. Okay, spread it out. That's the best technique. Okay, because then you're always learning something new. You do it once, you learn from what you've done, you look at the memo, you check it, you tick it, you see, okay, what didn't you get right? and then see if you understand what you should have done correctly. If you still don't, then bring it next week. We can look at it before we start the chapter 7 exercises. Okay, I'm going to start next week here. Chapter 7 exercise 1. We'll cover details regarding the accounting, taking all the theory into consideration. Right, so this week we've covered all the theory. The textbook covers it. I see Unisa Study Guide has also given you a lot of paragraphs highlighting specific things. Go have a look at that as well. Next week, I'm going to go through this example with you, and when we go through it, you'll see all of those things being discussed. Right, so you'll see they talk about shares, they talk about dividends, they talk about profit, they talk about those types of things. Right, and then we'll do the accounting. We'll do the debits, we'll do the credits for all the different transactions. Okay. All right, Cheryl.
Okay.